Have you ever thought about investing but didn't know where to start? Well, you're not alone. Investing can seem daunting, but it doesn't have to be. At its core, investing is about laying a little bit of your money aside now, and making it work for you, so it grows into a larger sum over time. It's a powerful way to accumulate wealth and secure your financial future. Think of investing like planting a tree. The seed you sow today, with time, patience, and care, can grow into a sturdy tree. Similarly, the money you invest now can grow exponentially over time, helping you achieve your financial goals, whether that's buying a house, funding your child's education, or ensuring a comfortable retirement. There are many ways to invest, from stocks and bonds to mutual funds and real estate. Each comes with its own set of risks and rewards. With the right knowledge and strategies, anyone can start investing. Let's dive into it. The first step to investing is understanding risk and return. Let's start with a basic principle. No investment is without risk. Whether you're buying stocks, bonds, real estate, or even stashing your money under your mattress, each choice carries its own unique set of risks. But here's the fascinating part. Generally, the higher the risk, the higher the potential return. This is what we call the risk-return trade-off. Think of it like walking a tightrope. The higher you climb, the greater the thrill, but also the greater the risk of falling. That's a bit like investing. The higher the potential return, the higher the risk. Now, unlike tightrope walking, in investing there's a safety tool you can use. It's named diversification. Diversification is essentially not putting all your eggs in one basket. It suggests spreading your investments across a variety of assets: stocks, bonds, real estate, and others. This way, if one of your investments faces a downturn, the others can help soften the impact. It's a potent method to manage risk while still giving you the opportunity to achieve robust returns. However, it's important to note that while diversification can help mitigate risk, it doesn't eradicate it. And irrespective of how diversified your portfolio is, higher potential returns will always come with higher risk. Always in mind, diversification is key to managing risk in your investment portfolio. Before you start investing, it's crucial to set clear investment goals. Just like planning a journey, your investment journey requires a destination. But what kind of destination? This is where SMART comes into play. SMART stands for specific, measurable, achievable, realistic, and time-bound. Specific goals are clear and well-defined. Instead of saying, "I want to be rich," say, "I want to accumulate a specific amount for my retirement." Measurable goals allow you to track your progress. How will you know you're on the right path if you can't measure your progress? Achievable and realistic goals ensure that you're not setting yourself up for disappointment. Remember, Rome wasn't built in a day, and neither will your investment portfolio. Time-bound goals give you a deadline. Whether it's saving for a house in 5 years or funding your retirement in 20, having a timeline helps keep you focused and motivated. Lastly, understand the difference between short-term and long-term goals. Short-term goals might include saving for a vacation or a new car, while long-term goals could be saving for retirement or your child's education. Clear goals will guide your investment decisions and help you stay on track. Now let's talk about how to choose the right investments for you. There's a smorgasbord of investment options available, each with their own unique features and benefits. You've got stocks, bonds, mutual funds, and ETFs, just to name a few. Stocks or equities represent ownership in a company. When you buy a stock, you essentially become a part owner of that business. They carry a higher risk, but also offer higher potential returns. Bonds, on the other hand, are a form of loan you give to an entity, usually a corporation or government. In return, you receive regular interest payments and the principal amount at the end of the term. Bonds are generally considered safer than stocks, but offer lower returns. Then we have mutual funds, which are essentially pools of money from various investors, managed by a professional fund manager. The manager uses this pool to invest in a diversified portfolio of stocks, bonds, or other assets. Lastly, there are exchange-traded funds, or ETFs. These are similar to mutual funds but are traded on stock exchanges, just like individual stocks. They offer a way to invest in a diversified portfolio with the flexibility of trading like a stock. Remember, the right investment for you depends on your financial goals, risk tolerance, and investment horizon. Are you saving for a house, your retirement, or your child's education? How much risk can you stomach? And how long can you park your money? These are some of the questions that can help guide your investment decisions. Choosing the right investment is a crucial step in your investment journey. Consistency is key when it comes to investing. Just like training for a marathon, you can't just run once and expect to be ready. Investing regularly, not sporadically, is what will help you build your wealth over time. Let's take a moment to talk about a technique known as dollar cost averaging. This strategy involves consistently investing a fixed amount of money at regular intervals, regardless of the market's ups and downs. This approach can actually work to your advantage in a volatile market, as you buy more shares when prices are low and fewer shares when prices are high. Over time, this can result in a lower average cost per share, which can potentially lead to greater returns. By investing consistently, you're not just putting your money to work, you're also harnessing the power of compounding. This is when the earnings on your investments are reinvested and begin to generate their own earnings. It's like a snowball growing as it rolls downhill. Remember, the most important thing is to start investing and keep investing regularly. Let's summarize what we've learned today. We began by introducing the concept of investing, which is essentially putting your money to work for you. We dove into the crucial relationship between risk and return, highlighting that higher potential returns often come with greater risks. Then, we focused on the importance of setting clear and realistic investment goals. Whether it's saving for retirement, a new car, or a dream vacation, having a target can guide your investment decisions. We also explored how to choose the right investments. Remember, diversification is key. Don't put all your eggs in one basket, spread your investments across different assets like stocks, bonds, and mutual funds. Lastly, we emphasized the power of investing regularly. Consistent contributions, no matter how small, can lead to significant growth over time, thanks to the magic of compound interest. Take these steps, and you will be well on your way to becoming a successful investor. Happy investing!